Let's get more on that burst of positive economic news out this morning. Revised inflation-adjusted GDP for the second quarter came in at a healthy 3.8%. That was stronger than the 3.3% figure that was previously reported. And meanwhile, in a sign of strength for the labor market, initial jobless claims edged lower to 218,000, and July existing home sales, which just crossed, ticked higher to just over 4 million. So how does the U.S. economy keep chugging along amid what seems like a drumbeat of dire predictions? Joining me now, Jeremy Siegel, Wharton Professor Emeritus of Finance. Jeremy, it's great to see you. It's been a while, so it's good to catch up.
Yes. Good to see you, Joy.
You know, I am so interested in the trajectory of the economy this year because once again, we had a year in which economists were feeling pretty pessimistic, right? Even before we got those tariff headlines, the worst of the tariff headlines in April, there was a lot of pessimism out there. And seemingly, the economy has held up a lot better. What's been behind that?
Yeah, well, I really think the tariff really is what shook everyone. The so-called Liberation Day really started, the terrible sell-off in the market and consumer sentiment. But things have been much better than people had expected, and for a number of reasons. One is the tariffs are nowhere near as bad as what Trump put out in April. So there's been a lot of deals, a lot of negotiations, a lot of exemptions. I don't like these tariffs. I don't think this is the way to do them, but they have not been as bad as originally feared. Secondly, we do have an AI boom. And we do have the promise that whatever extra costs corporations might experience because of the tariffs, they might be able to obviate because of the implementation of AI. In other words, the improvement of productivity that AI promises can offset some of those extra costs of the tariffs. On top of that, we did get a new tax bill that is very, very generous to expensing capital equipment. This has done a good job for corporate profits. And secondly, the fall of the dollar, which might eventually hurt the consumer in terms of higher prices, is certainly good for our exporters. So there have been the positive impacts that have offset that negative tariff hit.
Is it strange to see in view of all of this strong economic data, a Fed cutting into that environment? Especially, you see this revision to GDP for last quarter. Do you worry at all about an overheating economy and a Fed cutting into that?
Yeah, I see that as a concern, but I don't think that inflation is really going to be a concern. Of course, Friday we get the PCE deflator. I expect that to come very much in line. In fact, there's even a possibility of one tick being a little bit lower than expected. I also monitor credit expansion, the money supply. It has been very tame. This is not something like what we experienced in 2021, 2022, off to the races. Commodity prices have been well contained. Oil, it has its ups and downs, but it has been, very level in the prices. Home prices are beginning to go down moderately. Rental prices are now finally going down moderately. So I don't see that we're on the verge of an inflationary trend. Now, the tariffs are going to affect quite a number of inputs, but again, I think the Fed needs to look beyond the tariffs. That's a tax increase, a one-time increase. It is not really driven by forces of increased demand in the economy. So actually, I support the continuing move of decline of interest rates by the Federal Reserve. I actually think that the Fed funds rate should drop into the mid to low 3% by next year, which would be 3 or 4 more cuts. So I don't think inflation is a problem. And I think that the slowdown in the labor market growth, which has a lot to do, of course, with the immigration policies of the Trump administration, that slowdown does actually call for some reduction in interest rates.
Gotcha. Okay. And I also want to ask about housing a little bit more, which you alluded to. We just got data for sales of existing homes or previously owned homes. They fell a little bit, down 0.2% in August, the annualized pace at 4 million. It seems like the high cost of a home is still a bit of a stumbling block for people. It was up 2%, median home sales price up 2%, $422,600. What's your view of those dynamics within the housing market right now?
Well, from 2020, when the pandemic began, to 2022, that 2-year period brought the biggest 2-year rise in home prices that we've ever experienced. I mean, that was a 45%. And then they continue to trend upward, not anywhere near as fast. Only in the last 6 months beginning to look like they've topped out. But yes, I mean, that's a source of a lot of dissatisfaction. I mean, it's the have and have-nots, really. I mean, 2/3 of Americans do own their own home. They're fine. Their home equity has gone up. But those that have been renters not only have seen their rent increase, but seen the dream of home ownership, which is, one of the American dreams, it looks farther and farther away. The only good news on this is we really are beginning to see a drop in those mortgage rates and a softening of home prices. It's not going to be something that suddenly makes everything affordable, but it is going to help a little bit going forward for those that need would like to buy their own home.
So, Jeremy, we've been talking all about the sort of economic backdrop, whether it's housing or some of the other elements that we've been talking about. I'm curious to get your view on stocks right now, though. We've seen, obviously, there's a little pause the last few days, but we've seen this big push higher day after day after day. Does that continue in your view? I mean, it sounds like you think the backdrop is pretty good.
I think the backdrop is good. I think we've got some more juice in this rally. It's hard to say, when, how much more. I certainly think we're closer to the top of the big increase we've had since the April lows, but I would not be surprised to see another 5 to 10% on this stock market before we level off and could have a reaction. Of course, as everyone knows, trying to predict the stock market in the short run is sort of a fool's errand. I guess I'm one of the very few academics willing to stick out his neck and and do that. I'm going to certainly be wrong a number of times, but I think I have my pulse on some of the basic market trends. I think they're still up. The end of August and September are notably very difficult months, and we're just getting, the end of September now, so we're seeing that little softening. October is usually only a bad month if September is a bad month. So a lot of people talk about crashes in October, but the truth of the matter is that crashes in October are usually preceded by dramatic declines in September. And clearly we wouldn't have not had that.
Right. Yes, so maybe it bodes well. And Jeremy, the fact that you have an opinion is one of the reasons that we like to talk to you. So thanks so much for joining us here today. Take care.
I will. Thank you, Julie.
Thanks.